Data from the Nigeria's National Bureau of Statistics shows headline inflation rose to 26.72% in September. The trade negotiations between Kenya and the United States enters the third round last week with 4 items listed for negotiations. Plus, in Zimbabwe, worker exodus intensifies, depleting the country of essential skills needed for a turnaround. Hello, welcome to the program. I'm Ladi Williams. Let's kick off with the markets now. First up, major equity markets right here on the African continent. At intraday, we see most markets we track. They opened the week positive at intraday, with the NGX there up 0.06% at intraday. Marginal increase. South Africa's index is up 0.12%. In North Africa, we see a big move there, 3.76% up for the EGX 30. In Egypt, a lot of bullish sentiment right there at intraday, while Kenya closed down 0.34% on Friday. To other markets, now in the Middle East, we see it's mostly negative sentiments right there. And the UAE, 0.04% down for the Abu Dhabi index. Dubai index down over 0.5% at intraday. Other markets we track there, we see the Saudi index, that's a lone gainer there. Marginal increase, 0.03%, while the Qatari index firmly in negative territory, down 0.80%. Let's head on to London now. Let's take a look at what's happening there. We have Juliana standing by. Great to have you, Juliana. So we see UK house prices up, but at the slowest rate post-summer since the 2008 crash. How's this being digested over there?
Yeah, that's absolutely right. Good afternoon, Laddie. The housing market in the UK has been pretty tumultuous over the past year. If we cast our minds back to what happened when Liz Truss was Prime Minister, she sent the bond markets in a fury, and since then it's been very difficult for prices to recover. If you couple that with what we've seen out of the monetary policy meetings with the Bank of England, we know that they retained rates at 5.25% in September. But for 14 consecutive months prior to that, they were hiking them consistently. And this, of course, impacted mortgage rates. So what we're seeing is that landlords who own homes are trying to get the best that they can from prospective home buyers. But then, of course, because we've got the backdrop of a cost of living crisis, prospective buyers want to get the best value for their money. So that's all impacting the bottom line. So we do have a figure actually from Rightmove, which is a really popular property website here in the UK. The average price of a home is £368,231. That is about 370 million naira, Laddie. So even though we have seen a dip of 0.5% month on month, it is still, and I say this every time we talk about house prices in the UK, incredibly expensive to buy a home here. And if you want to live in London, you basically have to double that price for an average family home. Is this going to last? We're not sure. There's also separate data that was released by Rightmove, also saying that sales have dipped 17%. And again, I think this goes back to the fact that a lot of people are really struggling right now, particularly as we're getting into the winter months. We were speaking this morning on your show Business Morning about gas prices peaking last weekend at some of the highest they've seen in 6 months. So we are going to a time when energy bills are expected to be high, wages are still stagnating, inflation is still quite high. So if you are somebody that is struggling at the moment, of course, purchasing a home, particularly at nearly £400,000, is not going to be your priority.
Right, Juliana, I'm just wondering when consumers are going to get a break, when it's one bill after the other. But it's a fresh, brand new week. What market moving data are we expecting in the UK?
It is a fresh week, though. The days and nights are rolling into one. The Prime Minister, Rishi Sunak, is actually live at a Jewish school in North London. He's trying to reassure the Israeli Jewish community in the UK that Britain stands shoulder to shoulder with them, although, of course, as you can imagine, considering how diverse we are in England, that a lot of people are not happy about that. I think the Israel-Hamas war is certainly going to dominate geopolitical fragmentations and discourse over the next few days. That will almost certainly leak into the markets, but more closed data. Tomorrow we are expecting unemployment data from the UK. It's kind of hovered around the same 4.3%, which if you look at that internationally and historically, that is still quite low. However, there are many people that are still off work due to long COVID, something we haven't really spoken about in this country enough, because a lot of people are very sick because of COVID still. On Wednesday, very important inflation data. Inflation is currently at 6.7%. It has come down from those peak double digits. It's expected to fall marginally to 6.6%. We've just come off the back of the IMF gathering in Marrakesh, where they have said we are going to expect sustained high interest rates. So it will be interesting to see what that data really is going to be. Then on Friday, we get retail sales data. And again, we know that retail sales are falling because of the cost of living crisis. People are holding back on purchases because they're saving for a term I'll use again. I know it's only October, Christmas. Retailers really hoping they can finally claw back some Christmas money. Of course, we were on lockdown for a couple of years, but as we go again into another difficult quarter, it is going to be tough. So expecting retail sales to dip.
Right, and talking about inflation, we did get our data today. We're at 26.72%. I'll take your 6% any day, Juliana. But how are the markets kicking off the week?
Yeah, 26 is very high. You'll take the house prices, we'll take the inflation.
Right, let's just switch.
Yes, well, we actually got some data from EY Item Club looking at UK GDP, and they have forecast that perhaps the UK may not be on the brink of a recession. Are they? Aren't they? Are we? Aren't we? We're just not too sure at the moment. But that positive sentiment lifted markets. So at intraday, the all share is up. It's up by 0.40%. Laddie, the FTSE 100 up to at 0.43%. The FTSE 250, the domestic market, that's up by 0.27%. In the currencies market, the British pound is currently trading higher against the US dollar by about 0.08%, though it's trading flat against the euro intraday, and it's up against the Japanese yen by 0.07%. That's the British pound, Laddie.
All right, Juliana, thank you so much for the update. Catch you again tomorrow. Thank you. Let's take a look at what's happening in Europe now. See, the war between Israel and Palestinian terror group Hamas is intensifying. And while the violence and loss of life in the region is the most horrible aspect of developments there are also worries over an economic fallout. Lars Holter is with DW, and he joins me right there from Berlin. Great to have you, Lars. So are there already any economic developments that can be traced to the conflict in the Middle East?
Hello, Ladi. Thanks for having me. Yes, there has definitely been a direct impact of the war on the economy already. Unsurprisingly, as analysts have immediately been worried about rising geopolitical risks for financial markets. And as we are looking at the situation there right now, with Israel planning a massive ground assault against the Hamas-controlled Gaza Strip, it's clear that things will be getting a lot worse, and we'll have to pay close attention. Mostly, of course, to oil prices. We've seen some movement there over the past few days. On Friday, crude was up 6% as investors priced in the possibility of a wider Middle East conflict. Meanwhile, safe haven assets have been rising in value. Gold, for example, is up more than 3% for the past week. The US dollar is up as well, while stock markets have seen some weakness.
And what are analysts expecting might happen next?
Well, they are mostly worried about another rise in oil prices. Again, not much of a surprise here. While Israel is not a major player, other countries in the area certainly are, and we can't be sure at this time that they won't immerse themselves in the ongoing conflict between Israel and the Hamas. For now, at the beginning of the new trading week, oil markets are flat, but that seems to be mostly as investors are waiting to see what exactly will happen. Because one thing is sure, at least since Russia started its war in Ukraine, it should be very clear to anyone watching that geopolitical problems have immediate economic consequences, especially looking at oil and more generally energy markets. Now, an expanding Middle East conflict would likely lead to further rising oil prices, and that would cause inflation and, as a byproduct, likely interest rates around the world that could accelerate further, with one notable exception, the United States, and that's due to the greenback, often seen, as I just said, a safe haven investment, and a strong currency there would be a counterpoint to inflation. So actually, some experts have argued that the war could lead to interest rates in the US going down.
Other than the Middle East, what are investors looking at in today's markets?
Yeah, not very much outside this overwhelming topic of the Middle East war. Markets seem weak today, and there is not much data on the docket. Some retail and home sale numbers will be coming in from the US, but that's going to be later in the day. There's also a massive bankruptcy in the US, pharmacy chain Rite Aid filing a Chapter 11 bankruptcy on Sunday, and that's a move that would halt lawsuits the drugstore chain is facing over its alleged role in the US opioid crisis.
All right, thank you so much. That's Lars Holter right there in Berlin. Thanks for the update. All right, we see as the IMF World Bank meeting ends in Marrakesh, Morocco, one of these sessions delves into a crucial and complex issue that impacts economies around the world. Just as the international taxation landscape is rapidly evolving, a roundtable discussion took place which brought together tax experts, policymakers and representatives from G24 member countries to address the challenges and opportunities. Take a listen. A group of experts and leaders who have been discussing global tax policy reforms and the options available for G24 member countries. This panel session is crucial given the changing dynamics of the global economy and its impact on tax systems. The discussions kick off with the opening remarks from the Minister of Finance and Public Credit, Colombia, ICRICT Commissioner, underscoring the significance of fair and effective international taxation systems. They stress the need for G24 member countries to actively participate in the ongoing global tax reform efforts.
That's the OECD for the toolkit it uses. And that's also an opportunity to assess what are the assumptions about what's going to be the evolution of the digital economy in the future.
Other panelists reveal the challenges faced by these countries in the current international taxation framework.
Inclusive framework on base erosion and profit shifting and global forum on transparency and exchange of information for tax purposes has led to international standards undoubtedly for BEPS and automatic exchange of financial account information. And in principle, everybody agrees with that. It's the underlying treatment that is an issue and the way it has been constructed.
Other participants engage in in-depth conversations about policy options for G24 member countries. They discuss the need for innovative tax measures, stronger domestic tax systems, potential benefits such as increased tax revenue and reduced tax competition, and regional cooperation to navigate the changing international tax landscape.
Developing countries, we need more internal resources, and the fact of having some multinational who not pay all the taxes they had to pay in our countries is a big problem. And specifically in a context where mobilizing resources become a very tough question for countries like ours. So we need to do our best to that the multinational pay what they have to pay for our countries.
The fact is, this global tax reform, the main aim was to put an end to tax avoidance, to reduce also tax competition between countries, and with all that, to contribute to increased revenue collection in every country, developing and developed economies, but also to contribute to reduce inequalities. because it would recover also fairness in the design of international taxation. This tax system was completely outdated, and it was designed 100 years ago more in response to the interest of rich economies. Now what we need is a system that is fit for purpose for the reality of business in the 21st century, but it also responding to the needs, to the interest of other economies and not just the rich countries.
As this roundtable wraps off, it's clear that international taxation is a complex and critical issue that requires the collaboration of nations to address. The insights and recommendations generated will play a pivotal role in shaping the policies and strategies of G24 member countries in the ever-evolving global tax. All right, take a break now. When we come back, more stories from the African continent. Do stay with us. Welcome back. Well, the FX market distortions impacting major players in the fintech space. Let's get a sense of what to expect with Tunde Burema, now founder, Cardify, joining me via Zoom. Great to have you on the show.
Thank you for having me.
Yeah, so today, it's quite a lot happening right now with the FX market. How the recent distortions, impacting, your industry? I know you deal a lot with dollars.
Yeah, so the recent distortions in the forex exchange market have had a significant impact on the fintech industry at large. These distortions characterized by fluctuating exchange rates and limited access to foreign currencies have created challenges for businesses like ours, particularly operating in sectors that have to do with international transactions. However, the root cause of these FX distortions is that the supply of dollar into the economy has been declining while demand for dollars has relatively been rising. On the one hand, supply is basically inflow into the external reserves, which comes from export earnings, diaspora remittances, foreign investments, etc. On the other hand, foreign exchange outflow represents demand from the reserves, which occurs through funding of importation, external debt servicing, payment for services, etc. So when the inflow is more than the outflow, the foreign reserve rises. And when the outflow is more than the inflow, the external reserve tanks. So the volatility in the market is primarily due to the fact that the market must always find its level. And the reality is that there is higher demand for a limited supply.
And are customers still heavily demanding USD on your platform?
Yeah, so with respect to my industry, the most prevalent demand for the US dollars is used to pay for services, which amounts to outflow in the bigger context. Recall that there was a ban on direct FX sales for about 43 items, which were mostly food items, although the ban has been lifted, but contrary to those items, which can be produced locally, most international payments and subscriptions have to be remitted internationally. This is why your digital payments for softwares, online courses, international school fee remittances, subscription for streaming services, digital services in general, and even e-commerce purchases. So the demand for dollars has remained relatively high, especially for individuals and businesses that engage in international transactions. Although there has been a notable shift in user spending pattern. Users now spend more on essential platforms than they do on non-essential platforms, and that can be attributed to an increase in the cost of acquiring these dollars, due to the FX market distortions you mentioned. Overall, the demand for dollar remains strong, but businesses are exploring ways to reduce dependency on it.
Since we're seeing a lot of reversals now with CBN policy, do you think at some point they'll allow Nigerian cards to be used on the app stores like iOS and Google Play Store? Because I know that you cannot use your Nigerian cards there. You have to get a dollar card. But do you see that reversing?
Yeah, I mean, that could be one of the ways the CBN wants to make these markets more efficient. We have seen very direct measures from the CBN in recent times, like the floating of the naira. We have also seen, the use of willing buyer, willing seller model in terms of the I&E exchange. So. We expect the CBN to, keep coming up with, interventions to make sure that the market is as efficient as it could be.
All right, are there any new trends, in your industry? How you manage to carry out business, with this climate and all this distortion?
Yeah, I think there is a lot going on with respect to, remittances and not just focusing on spending. Nigeria has one of the fastest growing digital nomad communities in the world. These are young people who earn a living through providing online digital services, maybe by freelancing and all that. And the only legal PayPal account at this time that you can create and operate in Nigeria is the send-only type. That means you can only make purchases and send money, but you cannot receive money. So fintechs are kind of rising to the challenge of helping these digital nomads, a lot of them in Nigeria, to receive money, in dollars for these services by partnering with other foreign fintech companies to issue virtual dollar accounts, which can be used to receive, these foreign payments. And that is our recent focus at Cadify Africa.
All right, thank you so much, Tunde Barama. We do hope the distortions, end soon, because I can imagine how it's impacting, fintech players right now.
Yeah, we can't but hope.
Thank you so much. All right, let's take a look at some breaking news right here in Nigeria. See, Nigeria's annual inflation rate rose to 26.72% in September 2023, up from 25.80% in the previous month. According to the National Bureau of Statistics, this marks a 0.92% increase from August 2023. On a year-on-year basis, the September 2023 inflation rate is 5.94% higher than the rate recorded in September 2022, which was 20.77%. The report also highlights a significant increase in food inflation, reaching 30.64% year-on-year in September 2023, a 7.30% rise compared to September 2022, 23.34%. The data is in line with analysts' expectations, showing the consistent rise in prices due to recent policies, subsidy removal, and exchange rate unification. And in Zimbabwe, years of mass migration from Zimbabwe have accelerated due to ongoing economic crisis, further depleting the country of essential skills needed for turnaround. A recent census data from South Africa revealed an increase in the number of Zimbabwean immigrants in the country, with frequent migration between neighboring countries making accurate counts challenging. Immigration data from Zimbabwe also indicated that 85% of its citizens living abroad were in South Africa. This significant immigration is driven by a combination of economic challenges, high inflation, and policy missteps, and a low remuneration for professionals. And that's it on Business Incorporated. Thanks so much for watching. I'm Ladi Williams. I'll catch you again tomorrow. Bye for now.